Hello, and welcome to our webinar on the forthcoming changes to the UK's R&D tax relief rules. My name is Margaret Savory, and I'm a tax partner at James Cooper Creston.
Hello, and I'm Tracy Bacon. I'm a senior tax manager at the firm.
And in the background, we also have Georgia, who's managing the IT and the slides for us. So you might hear me refer to Georgia at times. We are recording this webinar and it will be made available to you at the end of the session. If you have questions, please do type them into your question and answer box, and we will save them for the end if we have time, or we will reply offline to you. Next slide, please, Georgia. Both Tracy and I spend a lot of time working with companies on their corporation tax affairs and claiming R&D tax relief. So we're going to spend the next 30 minutes or so giving you a heads up as to the changes in the rules which are in the draft legislation. First of all, we're going to start with a quick contextualization, giving you the background and reminding you of the key current rules as they stand. And then we're going to go and look at the changes. I've listed them here for headline only. There's some good news and bad news. Firstly, some good news. They've widened the definition of R&D to include pure maths. We're probably not going to say much more on that. We're going to look at the inclusion now of data licenses and cloud computing. And then we've got some restrictions looking at non-UK activities and some additional compliance requirements. Next slide, please, Georgia. So firstly, let's have a look at the context. In the government's roadmap, innovation and R&D features largely. The government's aim is that they want to increase the amount of GDP we spend on innovation. Currently, we're middling in OECD terms, spending about 1.8% of GDP. They want to up this by 2.4% by 2027. One of the key flagship policies is R&D tax relief to incentivize companies to do more R&D. So they want us to spend more on R&D. And indeed, they've done various studies to show that for every pound of R&D tax relief they give, they generate more R&D expenditure. So for the RDEC scheme, that's nearly £3, and it's a bit less for the SME scheme. And they're not quite sure why there's this difference. But in both cases, more innovation and R&D spend is generated by the use of R&D tax relief. So they're very clear that R&D tax relief is set to continue to the future. However, and this is the last bullet point, there is a problem with fraud and abuse. And indeed, both the 1920 and 2021 accounts for HMRC, which are audited by the National Audit Office, were qualified. And the National Audit Office said why they'd qualified them, and they said it is because of material error and fraud in COVID-19 support schemes, personal tax credit, and corporation tax R&D research and development tax reliefs. So they have to tighten up. They have to increase their compliance. Next slide, please. This just shows what changes have been in the last 4 years. The R&D tax reliefs have been around since the year 2000, but there has been active tweaking and changes in the last 4 years. As you can see, we've brought in the SME cap, which came in as a result of consultation that came in April 2021, and Tracy will talk a bit about that later. Then they've had a flurry of consultations and review and really thrown everything up for grabs with the R&D tax relief, which has culminated in the draft legislation being published with the new rules coming in from the 1st of April 2023. So a couple of points. This is currently draft legislation. There's very little practical guidance at the moment, and the draft legislation may change. It's not been enacted yet. And secondly, I've highlighted what we're really going to talk about here at the bottom here, which is the new rules, which will apply for accounting periods beginning on or after 1 April 2023. That's what the draft legislation says. It's not that the rules are coming in on the 1st of April, it's for accounting periods beginning on or after 1st of April 23. So this is a clear planning point to be aware of. Firstly, For example, if you have a 31 December 2023 year end, your first year in the new rules will be 1 January 2024. I caveat that it's draft legislation, but that's what it says at the moment. So you just need to think about when your first accounting period will start after the 1st of April 2023. I'll now hand over to Tracy, who will give you an update on the current schemes.
Yes, we thought we'd just have a quick recap on the two schemes. We have the SME and RDEX schemes, both of which will remain. The latter is for businesses that are considered large, so above certain thresholds as to employees and turnover, and also can be used for grant funded and subsidised projects as well, where the SME scheme might not be available. The table there sets out the benefits of the respective schemes in cash terms. Both schemes can generate a reduction to the corporation tax payment due if the company is profitable, or money from HMRC if loss-making, but clearly the SME scheme is more generous. The qualifying projects and cost categories are broadly the same for both schemes, but with some restrictions in claiming for subcontracted activity costs under the RDEX scheme. You can see there are some highlighted sections there on screen, which we'll be going into on later slides. Next slide, please. So I thought it'd be useful to see a snapshot of our current position and those changes that are coming in. The changes we're talking about today, as we've said, will affect accounting periods beginning on or after the 1st of April 2023 as things stand. The good news, cloud computing services and data licenses costs have been introduced as an extension to the definition of software. There aren't any changes to the rules for staff employed by the company, no matter where the work is carried out. The not so good news is there are new restrictions for certain non-UK activities. And so you might, after listening to the slides, you might consider whether work can be performed by staff in the UK if restrictions are likely to affect your claim. So we'll take a look at the details of these changes. Next slide, please. Okay, so starting with the good news, as we've said, software will include data licenses and cloud computing services. And the definition for these are shown on the slide and are straight from the draft legislation. For some businesses, this can be a significant cost and so a welcome inclusion and part of the modernisation of the R&D regime. Next slide, please. But there are some exclusions, as you can see, where a company can exploit the data or the licenses, or if the costs relate to a qualifying indirect activity. The qualifying indirect activity is set out in guidance, and there is a link on the slide there to that guidance. Margaret's now going to take you through some of the overseas aspects.
So one of the areas that they are going to tighten up on is to restrict R&D tax relief to UK-based activities, or one of a very narrow range of exemptions. And the aim of this policy is, this is what HMRC says, this is so that more of the spillover benefits, such as employee skills and industrial know-how produced by the activity, will arise in and benefit the UK. We have, of course, left the EU. We are now no longer bound by EU rules. So looking at the first bullet point, it's talking about UK or overseas. So broadly, UK activity, and the word in the legislation is activity is in, overseas is out, or they talk about, and we'll come on to that in the next slide, the definition of what's called qualifying overseas activity. And we'll take a look at that in a moment. What this applies to is subcontracted activities. So this is when there's an activity that you can't do yourself in-house. It's not a consumable, which is separately defined. This is things that you get other people to do. So this is either to a third-party company or organization, or maybe a fellow group company, connected party. It also includes in the RDEC scheme, this is when you can pay under the RDEC scheme only for independent research to be conducted at universities. So whereas before it was to universities on a worldwide list, it's now UK universities. And you have to decide, really, because just to remind you that R&D tax relief claims are part of your normal corporation tax self-assessment. So you have to self-assess and gather the support to decide whether it's UK activities or qualifying overseas activities. And it must be, if there's a bit of both, as it says there is a scope in the legislation which says you can apportion, and they use this phrase, just and reasonable basis. So you have to come up with a method of apportionment. Note at the moment, that's all we've got. That's what's in the draft legislation. There's no guidance provided as to how you will check this. So I pose a few questions. For example, if you subcontract in good faith to a third-party company based in the UK, how will you know if it then subcontracts on all the activity that you want to another country? So the activity itself takes place outside the UK. The law says, at the moment, the draft legislation says a draft activity. So I ask the question, how far down the supply chain will you need to audit? There is no guidance as yet. All I can say is, and Tracy will mention this often, document everything contemporaneously. Really important. Keep supporting documents. Justify your reasons as to why you've decided or you think it should be a UK activity or a qualifying overseas activity, which can be included. If we go on to the next slide, we will look at what is qualifying overseas expenditure, which is basically where you can pretend that it is like UK activity and include it in your R&D. It is very narrowly drafted. It must be related to the trade. So obviously, if you're developing a medical device or something like that, that's clearly your R&D is related to that trade. And then it says the conditions necessary for R&D, and these are all ands, must not be present in the UK. So you can't do it in the UK. However, it is present in the location where you are doing the R&D, and it would be wholly unreasonable for the company to replicate in the UK. So you need to think about contracts where you subcontract overseas, that you need to tick off all three things to be able to go, yes, this is qualifying overseas expenditure, and I will include it. The draft legislation then drills down and gives further definition as to what conditions it means by conditions. So if we go on to the next slide, it gives the definition of conditions. And note that the legislation also says the Treasury can amend this from time to time for better or for worse, but this is what it currently says. So it says a condition might be geographical, environmental, or social conditions. So think deep sea research. If you're researching the mid-Atlantic ridge, by definition, you probably have to subcontract to a submersible to go and be in the mid-Atlantic ridge. Or if you want to collect samples from Antarctica, you might have to subcontract someone to collect said samples from Antarctica. And by definition, Antarctica isn't in the UK yet. The other one, which is very relevant for a lot of the biotech companies with which we deal with, are talking about legal or regulatory requirements, as a result of which the R&D may not be undertaken in the UK. So this is the carve out for clinical trials. So for example, the FDA approval, which is the American regulatory body for drugs, they want data points from a US population, which by definition you will only get by subcontracting to a clinical research organization, CRO, based in the USA. So that would be a carve out. But they are very clear, and this is enshrined in the legislation, does not include conditions as far as relating to cost or availability of workers. So it's not good enough to say there's a skill shortage in the UK, so I had to go overseas and subcontract it. As I mentioned before, the government has talked about the spillover. This UK policy, the idea of this is to bring the skills into the UK. just in terms of thinking about practical tips, for each subcontracted activity, I would be recommending you need to look at the contracts and go line by line on those conditions to say, yes, we are definitely in the conditions, or it is definitely UK based. And this is the reason why we have included this subcontracted activity. That's all I have to say on the restriction bringing into the UK the subcontracted activity. Tracy, now back to you.
So next slide, please. So in a similar vein, actually, here we're looking at the changes to externally provided workers. And so much like the subcontracted activity, this aims to refocus the activity back into the UK. The definition has changed from staff provision payments to the idea of qualifying earnings. And you can see that's defined on the slide. For earnings that be subject to UK, PAYE and NIC. There's also the overseas condition that we've already just talked about that could bring some overseas costs into the claim if the necessary conditions are met. Whilst, of course, this is still draft legislation, and you can see that the health and social care levy is crossed through on the slide. It has been confirmed that this is scrapped from April 2023, and so we presume this will all be updated in the final draft. So with externally provided workers, what we're looking at is, say, a UK company using an overseas agency to source, for example, software developers who work in that overseas jurisdiction on the UK project. The agency pays local taxes in respect of those workers, and the reason for using that avenue is because of the lower cost. So there's no UK PAYE or NIC paid, and the necessary conditions are not met, and so the cost could be excluded from the claim. If the externally provided worker works partly from the UK and partly overseas, as we've already seen with the other subcontractor activity, then HMRC will accept a just and reasonable basis of apportionment. So again, as Margaret has said, it's important to keep those internal records to back up your method of calculation to support the claim. And also it may be appropriate to put that methodology in the R&D report that accompanies the claim as well. So Margaret will now take you through some new compliance measures that are coming in. Next slide, please. Oh, no, you're on the right slide.
Thanks, Tracy. So this is now the tightening up of the compliance measures, mainly in response to the fraud and abuse that has been identified. The National Audit Office, in their audit report for the 2021 accounts, estimated that across both schemes, both the RDEC and SME schemes, that 3.5% of the amount of tax given back is fraudulent, and that equates to £336 million of taxpayers' money, they estimate. So HMRC have to tighten up. So a couple of the things that they've done is that they've said they've put additional resources in HMRC. This is staff, employees, so 100 new R&D specialists in HMRC allocated to R&D tax relief. And they have introduced what they call MREPs, which are mandatory random inquiry programs. So of that 120 staff are dedicated to spot checks, basically. So where there will be more random inquiries into your R&D tax relief claim. So those are some of their sort of practical measures. In terms of what's in the draft legislation, we've got a list here. And the first one is a big change, and it might affect people just setting up a new company or startup, is the requirement for advance notification. So if we just go on to the next slide, I'm drilling down onto that. So where advanced notification is basically to stop a load of people rushing in at the deadline for the normal R&D tax relief claim. So the normal deadline is 2 years after the year end. So if you had a 31 December 2024 year end, which I'm deliberately saying, which is after April 2023, you would normally have until the 31st of December 2026 to put in an R&D tax relief claim. Now they've said you've got to notify in advance of putting in that claim if you've never made a claim before. And the notification period is 6 months after the end of the claim period. So back to this 31st December 2024 year end, you will have to notify them, tell them that you intend to make a claim, and the deadline for that will be the 30th of June 2025. So only 6 months after your year end. And this is to stop people just putting in claims quickly on the final deadline 2 years after the event. So they feel you should know you're doing R&D. It should be on your radar. You should be thinking about it. You need to tell HMRC about it. What it also says there is watch for long period of accounts. This is because in tax terms, it differs from accounting terms. So in tax terms, accounting periods can never be more than 12 months long. So if you have an 18 months period of accounts, it will always split into the 12 months for the first accounting period for tax and then the last 6 months. So even though your accounting period may end way over, just watch out for that first corporation tax accounting period. And the draft legislation is talking about accounting periods as far as we're aware for tax. So you could end up having your deadline to notify actually being at your accounts year end. So just watch out for that. That's if you're new claimant. So think if you're a spin out, you're thinking of starting up a new company, just have that on your radar from the very start. I know I'm going to do R&D. Let's bung in a claim, a notification to HMRC. If you've made the claim in the past, but you've had a gap, I've got that with some clients that perhaps they've had a flurry of R&D. They're not necessarily R&D companies, perhaps engineering companies, building companies. They've had various projects that they've done some R&D, but they haven't claimed for a couple of years. They might need to be aware that if they decide to make a claim again, they will again have to advance notify if they've had a gap for 3 accounting periods. The good news is if you're just carrying on, you're an R&D company, you've always made R&D tax relief claims, and you're doing so consistently every year, no advance notification is required. But I think this might trip up a few people, so just be aware of this. Okay, so we want to tell the revenue. How do we do that? Next slide, please. Well, who do we notify? We tell HMRC. How will we tell them? Well, good question, because the legislation says HMRC will provide details as to what needs to be in the notification and the manner in which notification should be made. So I'm afraid this is a watch this space. They are still figuring that one out at present, but they've told us we will need to notify. So that's the first thing on the tightening up of the compliance list, advanced notification. So if you can pop back to slide 13, I think it is, we will have a look at some of the other measures. So we've dealt with advanced notification. The next one is something we do already because we all file online through the HMRC portal. We use the Alpha Tax software, which is the industry standard pretty much used by all, I think, the major accounting firms. And so as part of that, we automatically, everything is digital, including the submission of the R&D tax relief claim with the tax return. So nothing new there, but they've just put it into legislation. Everything's going to have to go in digitally. No more handwritten claims going in. And then the next bullet point is they want additional information required. Now, for us, this is just business as usual. There's nothing there that we don't insist that all our clients provide when we prepare a report for them or we assist them with preparing the report. They want to know what R&D is undertaken and a breakdown of the qualifying costs towards that R&D. And as you know, R&D for tax relief purposes is tightly defined in what was the BIS guidelines, the Department of Business and Innovation and Skills, the guidelines, they're known as the BIS guidelines, as to the definition and meaning of R&D for tax relief purposes. So a very specific set of definitions, and they want you to describe that. And then these are 2 very new things, but this is to encourage people and companies to really engage with their R&D claim and not just put in a number that they don't really understand how it's been made. So each claim will need to be endorsed by a named senior officer of the company. There is no mention of penalties yet in the legislation, but there is a thing called the Senior Accounting Officer rules for larger companies, where again they have to have a named senior officer of the company. And in those circumstances, there can be personal penalties. We're not seeing that yet with the R&D tax relief, but they could always go that way. But it's very important that you, as the company, engage with your R&D tax relief process. And indeed, us too, because the claims will also have to include an agent who has advised the company on compiling the claim. And we're perfectly happy to put our names to claims where there is R&D, genuine R&D being undertaken. But as it says there, we are still awaiting exact details of a lot of this. And again, HMRC have been given powers to change and ask for more information as required. I think that's all I have to say on compliance measures, but there is going to be a tightening up. So I think it's now over to Tracy.
It is. Thank you. So as the slide says there's just a few tidying up rules coming in, and so we just include them for completeness. So patent box is mentioned, but only to ensure that the new R&D rules are taken into account when doing the patent box calculations and the R&D fraction. There, as we've mentioned before, there's the inclusion of pure maths, but we're not covering that in this session. HMRC are now given powers in order to reject a claim in case they cannot find any other means to reject it. And then the payment condition, that's one that has informally been in place as a matter of practice between HMRC and the profession. And it means that as long as accrued amounts in the accounts are paid by the time the R&D claim is made, then the costs can be included in that R&D claim, but this is now just included in the draft legislation. Next slide, please. So whilst the SME cap is not part of the changes coming in 2023, it's already in existence. We just thought we'd take the opportunity to have another look at it. The SME cap is potential restriction on the cashback under the SME scheme on the surrender of losses. And as you can see there, the restriction is based on £20,000 plus 3 times the PAYE and NIC liability in the period for the company. The PAYE and NIC taken into account is the company total. It's not just that in relation to the R&D staff, and it can also include any related to connected party, subcontracted activity, or externally provided workers as well. But there is an exemption there from the cap designed to protect companies which perhaps have no or very low staff, but do engage in substantial and genuine R&D, which is detailed in the slide there. If the exemption from the cap does apply, it would be sensible for the company to make sure that they keep records relating to its IP, the creation and management of it, so that that exemption is supported. Next slide, please. So Margaret, for you.
Thanks, Tracy. So that just recaps. We've basically told you all the changes that are about to take place. But what we thought with this slide, we would just think about things you can do now. So you've got 6 months before the 1st of April, and you may have even longer depending on your year end. So the first thing is to think about data and cloud costs, which was good news. So you can now include this, whereas previously the law just said software licenses, it's now these additional costs. So a couple of practical tips. Firstly, am I capturing all this data? Make sure it's clearly easily identified in your nominal ledger. But then think about maybe your year ends or delaying expenditure. So you get, if you know there's a big project or something going on, delay it and make sure it's in the year end when the new rules do apply. Currently at the moment, we know it's coming, but if we're dealing with a claim for current periods, we can still only claim for software licenses. Then there's a lot to think about in terms of subcontracted activities and the externally provided workers restriction. So thinking about planning this activity, so maybe bringing it forward. If you know that you've got a big slug of expenditure, try and bring it in before the rules change. Think about changing your accounting period so that you can push it forward. Remember, as we said, for example, if you have an accounting period beginning on the 1st of January 2023, you've got till 1st of January 2024, because that's the next accounting period, which is after the change. Think about whether can I do what the government want, bring the work into the UK. There might be increased costs, but I will benefit from the R&D tax relief to mitigate this. One planning point is also to think about, can my own staff do this work? Remember, as Tracy said at the beginning slide, staffing, if they're staff on your payroll, paying UK PAYE and NIC, maybe get my staff to do it rather than subcontracting it out. The next slide says, have I met the conditions necessary for it to be qualifying overseas expenditure? Let's start documenting it now to make sure I satisfy those 3 clear conditions, that the conditions aren't in the UK, that they do exist elsewhere, and it would be wholly unreasonable for me to do it in the UK. It's very clear that everything here, because it's self-assessment, you need to start documenting all your reasoning now or as the contracts go. So maybe think about having some sort of checklist for each of your big contracts so that you identify that it is UK activity or qualifying overseas expenditure. And then one other bullet point there is just think about, we haven't mentioned consumables much because nothing changes, but a consumable is something that is used and consumed as a result of R&D, and it can get a bit blurred, especially in the medical field, when you're developing products that are perhaps going to be tested on humans. Is that a consumable? Or if you've got someone to help you do stuff to test it, is that a subcontracted activity? Consumables are overseas. So consumables, remember, everything from anywhere in the world that you've bought to use and consume. So make sure you are being very tight and including things that are consumables as consumables, because that could be the difference between including it in the claim and if you incorrectly treat it as a subcontracted activity, then it might not be in the claim because it's overseas. And then finally, just a reminder, advanced notification, don't forget about it. Historically, people have gone, oh, I don't need to worry about the R&D tax relief because I've got a 2-year deadline. You do need to notify early. And again, as we said, watch this space as to the exact details. A reminder that this is all still draft legislation only. Typically, things don't change much, but they do tweak between draft legislation and the final enactment. We are also waiting for more practical guidance as well. So that really comes to the end of our presentation, to give you just a summary and make you aware and make you think with your own circumstances as of what things you might be doing now. And we'll see if there's any questions come up in the question and answer box. So I don't know if, which I haven't looked at. What have we got? One question saying, can you circulate the presentation afterwards? Yes, we will. I think this whole webinar is being recorded and will be uploaded. We'll certainly make sure delegates get a link to it. And then with the increase in measures, what is the current delay in paying claims? So the increase in measures, they're not coming in, but the increased compliance, it really depends. They're clearly being more focused. We're not experiencing too many delays with our claims, but then we submit reports and do the things that they want. I don't know if that's the case. They are working hard, they are dedicating resource, and they are getting through it, and they seem to be much more efficient. They've streamlined internally in terms of processing. So I can't answer other than more generally, and typically we're seeing sort of 4 to 6 weeks, but don't hold me to that. There's probably always an exception to that rule. If we have no further questions, then we will draw this presentation to a close. Oh, a couple more have come in just before we close. Are there still dedicated R&D units to contact? What they do is if you go onto the website, they have dedicated websites, but you can't really talk to the units directly. There is a phone number you can phone, and there is an email address which is to the R&D tax relief team. If you go onto the website, they will you'll see the details. Are agents equally liable for errors in R&D claims alongside clients? That is a technical question which I don't think I can answer generally. I'm not a lawyer. We'll restrict the scope to the changes in the R&D legislation. Though a very interesting question. I'm afraid I can't answer that one. So without further ado, if we give you our details on the next slide. As I say, I'm Margaret, and Tracy is with you.
Thank you for watching. And as Margaret says, any questions, we're happy to help.
Yes, thank you very much. And do send us, if you have other questions, our email details are there. This will go up. Give us the feedback. It's useful to know, and have a great rest of day. Thank you very much for attending the webinar.